Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Aluminum International Engineering Corporation Limited, latest report. China Aluminum International Engineering Corporation Limited offers a wide range of services and products to various industries. In the non-ferrous metals industry, the company provides engineering survey, design, and consultancy services for mining, ore dressing, smelting, and material processing activities. The company's services also extend to other fields such as metallurgy, transportation, housing construction, highways, building materials, electricity, water conservancy, municipal utilities, steel structures, aluminum, chemical, mining, and more. This indicates that the company is a one-stop shop for various engineering and construction needs. In addition to its services, China Aluminum International Engineering Corporation Limited also manufactures customized equipment such as metallurgical and processing equipment, environmental protection equipment, mechanical and electronic equipment, industrial automation systems, and mine safety monitoring and emergency response intelligence systems. These products are designed for use in mining, ore dressing, smelting, and metal material processing areas. The company's expertise spans multiple industries, making it a valuable partner for clients seeking comprehensive solutions. With its research and development capabilities, China Aluminum International Engineering Corporation Limited is well-positioned to meet the evolving needs of its customers. China Aluminum International Engineering Corporation Limited market capitalization of $18 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that China Aluminum International Engineering Corporation Limited holds a significant advantage in their industry. China Aluminum International Engineering Corporation Limited trades at a higher price-to-earnings ratio of 299 times and a higher price-to-book ratio of 2.7 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 79% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for the company can be identified through various key points. On the growth side, the EPC project general contracting and construction business segment saw a significant increase in operating revenue, contributing to a substantial 17 million yuan boost. Additionally, the equipment manufacturing segment experienced a notable rise in operating revenue, amounting to over 4 million yuan. Furthermore, an increase in credit loans by RMB 44,735 and design consulting revenue growth of 41.83% also contributed to the company's revenue growth. On the other hand, certain segments experienced decline. The EPC project general contracting and construction business segment saw a decrease in operating revenue of -11.7%, while the design consulting revenue declined by 23.2%. Moreover, a decrease in bank acceptance bills by RMB 101,465 also contributed to the company's revenue decline. Overall, these key points highlight the mixed performance of various segments within the company, resulting in a net revenue decrease of 4.1% from 2024 to 2025. The net income of the company experienced significant fluctuations over time. Initially, it increased by 44.14% due to improved project management and cost control. However, this trend was short-lived as it decreased by 3.93% later on. The net income then saw a substantial increase of 41.6%, followed by an astonishing surge of 977.5%. This drastic change can be attributed to the company's ability to secure high-quality overseas contracts and expand its international production capacity cooperation. The profit margins also underwent notable changes. The comprehensive gross profit margin increased by 1.33 percentage points, indicating improved efficiency in operations. Conversely, it decreased by 5.39 percentage points at a later stage. Meanwhile, the net profit margin saw a significant jump from 0.7% to 7.9%, largely due to the company's successful signing of high-quality overseas contracts and increased international production capacity cooperation. These developments demonstrate the company's ability to adapt and improve its financial performance over time. The company's financial performance has shown a significant improvement in its operating cash flow. According to the provided data, the net cash inflow from operations increased by RMB 3.586 billion year-on-year, indicating a substantial growth in the company's ability to generate cash from its core business activities. This positive trend is further supported by the operating cash flow figures for 2025 and 2024, which show a steady increase in cash generation over the past 2 years. The data suggests that the company has successfully managed its operations to produce a significant amount of cash, exceeding $1.2 billion in 2025 alone. The positive operating cash flow is a crucial indicator of a company's financial health and sustainability. It demonstrates the company's ability to generate sufficient cash from its core business activities, which can be used for various purposes such as investing in growth initiatives, paying dividends, or repaying debt. Overall, the data suggests that the company is generating positive operating cash flow, indicating a strong foundation for future growth and success. The company has experienced significant reductions in its debt level and interest expenses. A notable decrease in total interest-bearing liabilities by $293,460, page 80, indicates a substantial reduction in the company's financial obligations. Furthermore, net interest-bearing liabilities have also decreased by $370,555, page 80, signifying a considerable alleviation of the company's financial burden. The interest expenses have also seen a notable decline, with a year-on-year decrease and a specific drop of 25.4% from $370,758 to $277,267, page 420. This reduction in interest expenses is a direct result of the decrease in debt levels, allowing the company to save on its financial obligations. Overall, these changes suggest that the company has made significant strides in managing its debt and reducing its financial liabilities. The performance of various segments and regions has been analyzed based on extracted summaries. The domestic market and non-ferrous metals segment have performed well, with significant growth in these areas. China, both domestically and internationally, has also shown strong performance, particularly in the key sectors of non-ferrous metals and advantageous industrial sectors. In contrast, international markets such as Southeast Asia and Africa have had mixed results, with some fluctuations in performance. The EPC project General Contracting and Construction Business segment has been a notable exception, experiencing an operating loss of -$70,269. However, it is worth noting that no specific data was provided for China Aluminum International Engineering Corporation Limited's regions/segments in China, making it difficult to assess their performance accurately. Management is outlining a clear vision for the company's future direction. The focus will be on non-ferrous metals and advantageous industrial sectors, with 6 core business areas being developed to drive growth. These areas include resource engineering, mining engineering, and green low-carbon digitalization, among others. The company aims to expand its overseas operations and increase its share of international business, targeting rapid growth in scale. To achieve this, management will emphasize key sectors and regions for EPC, engineering, procurement, and construction business. The ultimate goal is to improve profitability while expanding technological advantages. This transformation marks a critical stage for the company, shifting from scale expansion to structural optimization. Management acknowledges that high-end, green, and intelligent technologies are reshaping the industry's competitive landscape and growth path. By embracing these trends, the company aims to stay ahead of the curve and drive long-term success. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. The records show that the company has paid dividends on multiple occasions, with specific references found in the provided summaries. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. This strategy allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining investors. Concerns about inventory buildup and supply chain disruption, the company's reliance on foreign imports for key minerals, has put pressure on resource security, as its domestic operational capacity is nearing its upper limit. This vulnerability to supply chain disruptions is further exacerbated by the high dependence on external suppliers. Furthermore, the warehousing services provided by Chinalco to the group may pose concerns about inventory buildup or supply chain disruption. The company's inventory levels have increased significantly, with a gross carrying amount of raw materials and work in progress rising substantially from 2024 to 2025. To mitigate these risks, optimizing subcontractor resources and strengthening centralized material procurement management are essential steps. By doing so, the company can enhance its resilience and security of the supply chain, reducing the likelihood of inventory buildup or supply chain disruption. That concludes the financial summary for China Aluminum International Engineering Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.